Welcome back. Today, we're breaking down how the ultra-wealthy legally pay so little in taxes. It's not about shady loopholes. It's about mastering the tax code and using it strategically. These strategies are available to everyone, but few know how to use them. We'll cover retirement accounts, real estate, charitable giving, trusts, and more. My goal: give you the tools to start thinking like the wealthy when it comes to taxes. Stick around for actionable tips that could save you thousands or more over your lifetime. Let's dive in. What is the bedrock of a wealthy person's tax strategy? What's the fundamental principle they all adhere to, regardless of their industry or income bracket? It's consistently maxing out tax-advantaged accounts. This is the cornerstone of building wealth while minimizing your tax burden. We're talking about accounts like 401(k)s, the go-to retirement savings plan for many, IRAs, both traditional and Roth, offering different tax benefits depending on your situation. And HSAs, health savings accounts, a powerful tool for those with high deductible health plans. These aren't just any accounts, these are government-approved buckets specifically designed to help your money grow with major tax breaks. They're essentially a partnership between you and the government to encourage saving and investment. Every single dollar you contribute to a traditional 401(k) or IRA is a dollar you don't have to pay income tax on in the current year. This immediate tax deduction is a huge benefit. The wealthy understand this implicitly and treat these contributions as non-negotiable. Maxing them out is step one in their financial playbook every single year, without fail. It's a commitment to their future financial security. For 2024, the contribution limit is up to $23,000 in a 401(k), a substantial amount that can significantly impact your retirement savings. And there are even plus catch-up contributions allowed if you're over 50, giving you an extra boost as you approach retirement. They also strategically use the backdoor Roth IRA, to cleverly get around income limits that would otherwise prevent them from contributing directly to a Roth IRA. This involves converting traditional IRA contributions into Roth IRAs, unlocking the potential for tax-free growth and completely tax-free withdrawals in retirement. Just imagine a multi-million-dollar account, where you never have to pay taxes on the gains again. That's the incredible power and long-term benefit of the Roth IRA. The process is straightforward. First, contribute to a non-deductible traditional IRA, and then promptly convert those funds to a Roth IRA. If you do it right and follow they are systematically moving as much of their wealth as possible into these tax-free havens. And let's not forget the often overlooked HSA. This is the coveted triple tax-advantaged account, a true gem in the world of tax-smart investing. Your contributions are tax-deductible, your investments grow tax-free, and withdrawals for qualified medical expenses are completely tax-free. It's a win-win-win. Many savvy investors treat the HSA as a stealth retirement account, recognizing its potential for long-term growth. They let it grow untouched for decades, maximizing the power of compounding. By diligently maxing out 401(k)s, utilizing the backdoor Roth IRA strategy and fully funding their HSAs, a wealthy couple can potentially stash away well over $60,000 a year in these tax-advantaged accounts. That's a significant amount of money shielded from taxes, working hard to build their future. This dramatically slashes their taxable income and allows them to build a massive tax-efficient nest egg that will provide financial security for years to come. The key takeaway here is that the wealthy don't just dabble in these strategies. They have a well-defined, systematic, and often aggressive plan in place to maximize these benefits. Their goal is to max out every eligible account every single year, without exception. They don't view the tax code as a burden, but rather as a set of incentives that can be leveraged to their advantage. So, the message is clear. Use these tax-advantaged accounts to your advantage. Embrace these strategies and watch your tax bill shrink significantly over time. It's the first, and arguably, the most important secret to how the wealthy manage to keep their tax bills so remarkably low. Real estate is the ultimate wealth-building vehicle. It's not just about owning property, it's about strategically leveraging assets to create lasting financial security. And a powerful tax-slashing tool, especially favored by the rich. They understand the game and play it well. The tax code is intentionally packed with benefits designed specifically for property owners, creating a landscape of opportunity. Especially savvy investors who know how to navigate the complexities and maximize their returns. Mortgage interest on investment properties is fully deductible, providing a significant tax advantage. And the wealthy, understanding the power of debt, strategically use leverage to maximize this deduction, amplifying their tax savings. But the real magic, the true secret weapon, is depreciation. The IRS, in its infinite wisdom, lets you deduct a portion of your property's value every year as depreciation, reducing your taxable income. Even if the property is actually appreciating in value, you still get to deduct depreciation, creating a powerful financial advantage. This creates what are known as paper losses, which are not actual losses, but rather deductions that can offset other income, sheltering it from taxes. Sometimes these paper losses are so significant that they can even offset your salary, drastically reducing your overall tax burden. The result of all this? Positive cash flow coming in from your properties, but a tax bill that, thanks to depreciation and other deductions, shows a loss, minimizing or even eliminating your tax liability. The wealthy understand this game, and they build entire portfolios specifically designed to generate these tax-shielding losses, maximizing their wealth accumulation. When it's time to sell a property and realize the gains, they strategically use the 1031 exchange. Sell a property, reinvest the proceeds in another like-kind property, and defer all capital gains taxes, essentially kicking the tax bill down the road indefinitely. They repeat this process, strategically exchanging properties for decades, swap till you drop, as they say in the real estate world, growing their empire, building substantial wealth, all while minimizing or even eliminating their tax burden. And when they eventually pass away, their heirs inherit these properties at a stepped-up basis, effectively erasing decades of deferred taxes, providing a massive tax advantage for the next generation. The cycle is simple, yet incredibly powerful. Buy with leverage, deduct the interest payments, reducing your taxable income, utilize depreciation to create paper losses, and further shield your income. 1031 exchange into bigger and better properties, continuously upgrading your portfolio, and ultimately, pass it on tax-free to your heirs, creating lasting generational wealth. This is how fortunes are not only built, but also sustained and grown over time, and preserved for generations to come, all by strategically using the tax code to your advantage. The wealthy don't just invest, they strategize. It's not merely about where you put your money, but you make those crucial moves. They time their moves for maximum tax efficiency, carefully planning each transaction to minimize their tax burden. This isn't about luck, it's about meticulous planning and understanding the intricacies of the tax code. The big distinction, the some patience and the rate drops to 20% or less, a substantial difference that can save you a significant amount of money. The rich are patient, understanding that time is on their side, holding assets for years to lock in lower rates. They understand the power of compounding returns and the benefits of long-term investing. They also use tax loss harvesting, a sophisticated strategy, selling losing investments to offset gains, strategically rebalancing their portfolio while minimizing their tax liability, reducing their tax bill even further. It's a proactive approach to managing their investments and taxes simultaneously. If losses exceed gains, creating a net capital loss, they can offset up to $3,000 of ordinary income, providing an immediate tax benefit, and carry the rest forward, using those losses in future years to further reduce their tax burden. Another advanced move, a strategy employed by the ultra-wealthy, buy, borrow, die. It's a counterintuitive yet highly effective approach to wealth management. Instead of selling appreciated stock and triggering capital gains taxes, they borrow against it, no taxes owed. This allows them to access the value of their investments without incurring a tax liability. They live off low-interest loans, using their investment portfolio as collateral. Let investments grow, compounding their wealth over time, tax-deferred. And when they pass, heirs get a stepped-up basis, resetting the asset's value to its current market price. Erasing capital gains taxes, the accumulated gains vanish for tax purposes. The result, a powerful wealth transfer strategy. They access wealth without triggering taxes, enjoying the benefits of their investments without the tax consequences. And their heirs inherit assets tax-free. A legacy of wealth, preserved and passed on efficiently. It's a masterclass in patience and strategy, a long-term game played with precision and foresight. Charitable giving isn't just about generosity, it's a powerful tax tool for the wealthy. Cash donations are deductible, but the real magic is donating appreciated assets like stocks or real estate. Donate a stock that's grown in value, and you deduct the full market value plus, neither you nor the charity pays capital gains tax. This double benefit is why the wealthy prefer giving assets over cash. Many use donor-advised funds, DAFs, contribute assets, get an immediate deduction, then distribute to charities over time. DAFs let you bunch donations in high-income years for bigger tax breaks, while giving you flexibility on when and where to give. The strategy: clean up your portfolio, avoid capital gains, get a huge deduction, and support causes you care about, all at once. For the wealthy, giving is both a legacy and a sophisticated financial move. At a certain level, protecting and passing on wealth is as important as building it. Trusts and private foundations are the tools of choice. An irrevocable trust removes assets from your estate, shielding them from estate taxes and ensuring more passes to heirs. Specialized trusts like GRATs let you pass future appreciation to heirs tax-free, a favorite for tech founders. Private foundations take philanthropy to the next level. The family controls the foundation, directs grants, and builds a legacy. Foundations offer tax deductions and capital gains avoidance, but require more oversight and annual payouts. For the ultra-wealthy, these structures mean control, legacy, and major tax savings. The bottom line: trusts and foundations are how fortunes become dynasties. Offshore accounts sound shady, but for the wealthy, they're often about legal tax efficiency and global investing. Setting up entities in countries with favorable tax treaties can reduce taxes on international investments. Major investment funds use tax-neutral jurisdictions like the Cayman Islands to pool global capital without extra tax layers. Wealthy individuals invest in these funds for efficiency, not secrecy. Offshore trusts in places like the Cook Islands offer asset protection from lawsuits, not just tax benefits. All of this is reported to the IRS. Strict laws like FATCA ensure transparency. The key: it's about using global rules to minimize taxes and protect assets, not hiding money. These strategies require expert legal and tax advice, but they're a standard part of high-level wealth management. Here's the real secret: the wealthy don't do this alone. They hire elite teams. CPAs, tax attorneys, financial planners, who work year-round to optimize every move. This isn't just about filing taxes. It's about proactive, strategic planning. A good tax team can save millions on a single deal, well worth the investment. Each expert brings specialized knowledge, trusts, depreciation, investments, and more. They coordinate every decision for maximum tax efficiency. The wealthy pay top dollar for the best advice because it saves them far more than it costs. The lesson: leverage expert knowledge. It's the highest return investment you can make. That's the playbook: how the wealthy legally minimize taxes. It's not one trick, but a comprehensive, strategic approach. The tax code is a set of incentives learned to use them. These strategies are complex, so always consult a qualified tax professional before making moves. What surprised you most? Drop your thoughts in the comments. If you found this valuable, hit like and subscribe for more. Thanks for watching. See you next time.